Welcome to the Ultimate Investment Showdown. Today we're pitting the two heavyweights of the financial world against each other, ETFs versus mutual funds. Which one belongs in your portfolio? Let's find out. Both are baskets of securities that offer diversification, but how they trade and what they cost could change your wealth building strategy forever. An ETF, or exchange-traded fund, is a basket of securities that trades on a stock exchange just like an individual share. You can buy and sell them all day long at live market prices. A mutual fund, however, is a professionally managed vehicle where you buy units directly from a fund house. The price is only set once a day at the end of the market session. Mutual funds have the legacy. They started way back in 1774 in the Netherlands, with the modern industry booming in the US by 1924. They've been the gold standard for decades. But in 1993, the game changed. The first modern ETF, the SPDR S&P 500, was launched, sparking a $1 trillion shift toward low-cost passive investing. Now let's get into the nitty-gritty. Here are the 4 critical differences you need to know. First, trading. ETFs are for the active trade anytime the market is open. Mutual funds are for the patient, transacted once daily at the net asset value. Second, minimums. You can start an ETF with just the price of one single unit. Mutual funds often require a set minimum SIP or a larger lump sum to get started. Third, management. ETFs are mostly passive, tracking an index like the S&P 500. Mutual funds are often actively managed by pros trying to beat the market for a fee. And that leads to the fourth, costs. ETFs generally have lower expense ratios and are more tax efficient. Mutual funds can be pricier, especially those active ones. Liquidity is king for ETFs. They're always ready to move. But mutual funds win on discipline with easy SIP options that automate your investing. Looking for examples? Popular ETFs include the Nasdaq 100's QQQ, the S&P 500's SPY, or India's Nifty BES, quick, simple and transparent. For mutual funds, think giants like the Vanguard 500, SBI Blue Chip, or HDFC FlexiCap. These are the pillars of long-term wealth building. The ETF advantage is clear: lower costs, instant access, and total transparency on what you own every single day. But beware, you'll need a demat account, and those brokerage fees can add up if you trade too often, plus there's always the risk of a tracking error. Mutual funds shine with simplicity, no demat needed, professional managers steering the ship, and the power of SIP to keep you disciplined. The downside: higher management fees can eat into returns, and exit loads might lock your money up for a while, and you're stuck with that once-a-day price. So who wins the battle for your money? It all depends on your goals and your style as an investor. If you want control, real-time flexibility, and the absolute lowest costs, Team ETF is calling your name. Perfect for the active market watcher. But if you want to set it and forget it, with professional management and automated discipline, mutual funds are your best friend for the long haul. Remember, the best investment is the one you actually stick with. Diversify, watch your costs, and stay consistent. That is how you win the game. Ready to dominate the market? Smash that like button, subscribe for more intelligence, and let's grow that wealth together.